So as a financial planner, I talk a lot with clients about retirement planning. And one subject that we can never get away from is the subject of taxes. And so I think there's a common misconception out there that says, hey, when I'm working, I'm in a relatively high tax bracket, and then when I retire, I'll be in a low tax bracket. That could be the case, but that is definitely not always the case. And so a lot of people really don't think about, hey, when I turn 72 and I have a 401k, an IRA, a 403b, those tax-deferred retirement accounts, which are great, but I have to start taking money out of those when I'm 72. That's called a minimum required distribution. I'll do a whole separate video on how that's calculated, etc. It's pretty straightforward, but you don't have to take it all out at 72. You just have to start taking it out at 72. So I think there's a nice window of time for a lot of people. Let's say you retired at a relatively early age, like maybe age 60 or something like that, and yet Social Security hasn't kicked in yet. You don't have to take your minimum distribution, although you still might be taking some IRA distributions just to pay the bills, but you don't have to take out that full minimum required distribution until age 72. There's the opportunity there. And so I think one great way to test that is for the use of planning software. That's what I do with my clients. I run some projections, I look at their expenses, and we break down, hey, if you're going to have X amount of expenses, that means you're going to have to pay X amount in taxes because you have to pull money out of accounts. And so it could be that some clients have a combination of brokerage accounts, retirement accounts, various buckets that they can take that money out of. But I wanted to show you just a couple of examples of something we can do about that, okay? So the planning software I use, we can run projections just about expenses and taxes and things like that. So this is just an example of a client that is retiring about 62, 63, and we projected their retirement expenses as time goes on. So you can see these blue columns here. Those are their expenses, and that goes up about 2.5% per year in this example. And then the purple represents taxes. So you can see here, if they're roughly about age 63, you see that first column there, that represents their first year in retirement. They have a little bit of working income still that year, so they're not really fully retired. And then once retirement kicks in, they're really not paying a lot in tax at that point. And so you'll notice that later on, perhaps around age 2032, that purple increases pretty dramatically. And that's probably because they're turning 72 and they're having to take out those minimum required distributions from the retirement accounts. So I actually had a client the other day, they said, hey John, how can I reduce that purple? And so very simple request. And so what I did is introduce the concept of Roth conversions. And so I want to show you a couple things here. And so I just picked a random number for this particular example for this client. I said, hey, let's project out at age 85, what your living expenses would be, and those are increasing with inflation. Those also include taxes. And notice the taxes are $104,000. Okay, and so because they're taking distributions from retirement accounts, and that's a pretty heavy duty dollar amount there. So what I did is basically introduce the concept of, hey, let's pay a little bit more tax up front in the early years, and let's do some substantial Roth conversions every year, and let's lower the taxes we're going to have to pay down the road. Just a reminder, if I convert money to a Roth IRA, basically any amount I convert to a Roth, I have to pay tax on that as ordinary income right now. But the benefit is that's going to grow tax-free for the rest of my life, or unless I take it out prior to that. You can see here what I did is on the front end, we increased the taxes, or the purple in this example, before they're age 72. Let's say that 72 is around year 2032 in this example. And you can see here that around age 2032, or the year 2032, when they're 72, the taxes are a lot lower. And so, in fact, let's skip ahead. I'm going to look at that same age 85. Taxes were about $100,000 in my previous example. Now it's about $50,000. You talk about a significant reduction in taxes. I mean, that basically cut their tax bill in half. So again, we're paying more on the front end because we're doing some Roth conversions, from retirement age until age 72. We're paying some tax on that, but the benefit is tax-free growth for the rest of their lifetime. And so that can be pretty powerful if you really break that down. So this is actually a chart. If you like to see kind of a spreadsheet or columns laid out here, this is if they didn't do anything. And so this lays out a little bit more clearly. This is showing their living expenses over time, starting at retirement. and those go up a little bit with inflation every year. And then also, if you look at the taxes paid column, you'll see there that they're really not paying a lot in tax until they're 62. Look at that big difference once they're 72 as far as their tax bill goes, because they have to start taking out retirement distributions from IRA accounts. And that's a really big deal. It could be in retirement. And so if you look down at the bottom of the taxes paid column, over their lifetime projected, for this particular couple, at their age 94 and the spouse is age 90, that's about $3.2 million in taxes that they're cumulatively going to be paying. So what I propose to this client is, hey, let's pay a little bit more tax up front in these early years. So let's look at the results of having done some Roth conversions early on, paying a little bit more tax on the front end and less money in retirement on the back end. So let's look and see what that looks like. So this is doing a nominal amount of Roth conversions from age 63 to 71, and you'll see that we are paying more tax at that time. Okay, you'll see there from age 63 to age 71, our tax bill increased, and so we're basically converting money to a Roth a little bit every year, and we're paying tax on that. But now we have this big tax-free pot of money that we'll never pay tax on again. It could grow to infinity. It's tax-free. So let's look at the bottom line. If you look at that taxes paid column, look down at the bottom of that. Now our total tax liability is like $1.8 million over our lifetime. It's still a lot of money, but it's a heck of a lot less than what we were projected to pay in that first example if we did nothing. We just let those retirement accounts run their course over a lifetime. So I think that can be a very powerful example. If we do some Roth conversions early on, upon retirement, then you're really going to get to stuff some money into that Roth IRA, and that's going to grow tax-free. It's not for everybody. Some people maybe can't control their tax rate at retirement. Maybe they have a deferred compensation when they retire, and that's going to carry them for 5 to 10 years, and you're still going to be in a high tax bracket. That may not be a good opportunity. Some people might truly be in a lower tax bracket in retirement. Maybe they have maybe like this client had more IRA money than they did taxable money. Maybe it's flip-flop for some people. Maybe they have more taxable money than they do IRA money. So it could be just a different situation altogether. So I think it's a tremendous opportunity to look at that with your advisor. If you retire, what are the tax ramifications going to be for every year until you turn 72? When you can't do anything about it, you have to start taking those minimum required distributions. I've been a financial planner for well over 25 years. Please work with somebody that knows what the heck they're talking about. You don't want to mess this up. And I would strongly recommend that you work with a professional tax advisor before you take any money out of a retirement account, because you really want to make sure that you're doing the right thing and not paying too much tax, or in some cases too little tax. So if you have any questions, please reach out. My contact information is in the About section of my YouTube channel. And thank you so much for watching my video.